I'm Justin Spaulding, owner-operator of 2,000 apartment units. We have 200 investors. This is Want to Know Wednesday that I'm going to go through right now, talking about seller financing, and we're coming at you every single Wednesday, 4:30 p.m. Central Standard Time with a new video. Please hit subscribe, leave a comment, like the video. In the comments is usually how I find next week's question for Want to Know Wednesday. So you guys get to drive the content, leave a question. This week's question came from Chris Wormley, who asked, what's the interest rate look like on a seller financing deal compared to your own money? So I don't necessarily understand the entire question, but what I wanted to do, since he had that question, which I think I'm definitely going to hit it by spraying a lot of seller financing info in this video and actually sharing our actual seller financing experience on a deal that we did about 6 years ago that we had for about 30 total months that ended up paying us well over $1 million in just 30 months, like net, like free cash flow, free money from the cash flow from the sales proceeds. There's a lot of different ways and a lot of different scenarios with seller financing, and really in general what you need to realize, what all you guys need to realize, deal structure, this is your deal structure. And what I mean by that is it is a blank white canvas that you get to be the artist of. So these terms that I talk about, when I talk about the percentage down, when I talk about the interest rate, when I talk about down payments, when I talk about all that stuff, it can be structured in such a way. When I talk about how we came up with some investor equity that I'm going to talk about in this video, it was all because I started with a blank slate. I didn't just go by off of what someone said, but I realized that deal making is a blank slate, and I can be the artist, and I can create and make the terms whatever I want to make the terms. And that's why there's a lot of times that I talk about, it's not as much the price. And when you're going to buy a business, when you're going to buy a piece of real estate is business. Stop looking at real estate as just a piece of property. It is a business that you need to operate and pay attention to. But when I talk about buying businesses, when I'm talking about buying real estate, there are times I'm much less concerned about the price, and I'm much more concerned, and I focus much more on the terms. Because if you get the right terms, you can pay any price. For example, if you have a property that you think is, let's just call it, we say it's a $1 million property. The market would say it's a $1 million property. You being the seller, you're like, well, I think it's actually 1.2, right? Because we never truly get the seller. The seller always thinks the property is worth more than what it really is, right? What a buyer's willing to pay. I could come along and I could say, you know what, John, I'll pay you $2 million for the property that you think is $1 million. And you're like, you're blown away by it. But my terms are, I'm going to pay you that $2 million back over the next 250 years. I'm going to divide $2 million, I'm going to divide it by 250. 2 million divided by 250 years. That means I'd pay you $8,000 a year to control the property. Because I really just want to be able to control the property, right? And if I can position myself, I'll pay you $2 million if I can pay you back over 250 years, right? Does that make sense? Because I'm positioning myself to basically only have payments of $8,000 a month for that thing that is going to bring in $120,000 a year in net operating income. Those are estimated numbers, so don't check my math. Does it make sense though how important the terms can be, especially when you're getting into seller financing? And seller financing is very, very common in a lot of businesses that are doing anywhere from $5 million a year and under, sometimes up to $10 million, $15 million a year. There's seller financing components in those or earnouts. And so the terms of those things can be much more important than the price. So as a buyer, you want to remember that, hey, this is a blank slate. I need to focus on terms. That being said, what I've kind of got here is I'm going to go through for our seller financing deal that we did with those storage units a couple years back. I'm going to kind of go through how we actually set that up. And I'm also, which we went the seller financing route, which is what this video is about. We went the seller financing route, but I'm going to show what would have happened if it was in a traditional lender, or if we had no debt and just paid all cash like some people out there want to do and they think is good. I'll never have zero debt. I don't want to be in a position where I have zero debt. The purchase price of those storage units that we bought in 2015, 2016 was they were $1.2 million. In this scenario, the price is not changing whether I use no debt and I pay all cash, whether I use a traditional bank loan, or whether I use seller financing. The price is the price is the price, meaning 1.2 if it's all cash, 1.2 if it was seller financing, 1.2 if it was traditional lender. What does change is the debt, right? Which is a term. It can be considered a term. So I'm talking about price, and I'm talking about paying attention to your terms. I'm talking to you paying attention to, hey, this is a blank slate. You come up with your terms, what you want to pay your investors. You come up with your terms on what the seller financing terms look like. The debt, if I paid all cash, how much debt would I have? 0%. Or 0%, $0. If it was traditional, let's just say that it was 75% that the bank was willing to loan. It was me $900,000 loan on this $1.2 million property, meaning the equity that I got to put into this deal is $300,000. The equity I got to put in an all-cash deal on a purchase price of 1.2, since there's zero debt in an all-cash deal, I'm putting in my own equity of $1.2 million. Traditionally, $1.2 million purchase price at a 75% loan-to-value, meaning the bank's going to give me 75% in the form of a loan to put towards the $1.2 million purchase. I got to come up with my own equity of $300,000 in this scenario. The seller financing route, when I was out there at the storage units, I was looking around and I saw a lot of opportunity. And I also saw a very desperate seller at that point in time. He was older, ready to get rid of it. His brother, his mother had passed away. His brother and him were operating it. His brother kind of started to disappear. He was operating all himself. He did not have very much debt on this property. He wanted $1.2 million. He knew that. But he didn't have very much debt. He had like $200,000 of debt. And so as I'm sitting here and I'm looking around, and I was not interested in storage units at the time, but I was sitting there looking around and I saw that there was 75% occupancy rate. And I knew that we could fill those other units up. I knew that we could get to 90, 95%, 100% occupied. So in my mind, I'm like, man, if I can create the deal terms, no one else thought this thing was worth $1.2 million. That's why it sat on the market. But I'm like, man, if I can come up with the right deal terms, going back to, hey, I'll pay you $2 million for your $1 million property, if Mr. Seller, Mr. or Mrs. Seller, I can pay you the $2 million back over 250 years. I'd do that deal all day long, right? Very cheap debt. So in this scenario, I'm like, okay, this guy is like fixated on $1.2 million, which sometimes you're going to have when you go to buy a business from somebody. You're going to have a seller that in his mind wants to be able to just say, I sold it for $1.2 million. I sold it for $5 million. The rest of the market was offering him like $800,000. For me, I'm like, how can I get this man $1.2 million, but structure it in a way that it's still going to be a success for me? So when I'm sitting there and I see the 75 units, the 75% occupancy, I see 25% of the units, the storage units, and some of the commercial shops vacant, I immediately thought, I'm like, okay, how can I structure this? So I'm like, okay, let's do seller financing. I get to dictate the terms. So what we did was I said, hey, I'll pay 1.2 that you want, but I'm gonna have to ask you this: are you open to seller financing? Because to get you to your number, we're gonna have to do some seller financing here, or I can't get to your number. And he immediately said yes. So then what happened was I didn't just negotiate right there on the spot. I kind of went home. I said, hey, give me about 20 minutes. I'm gonna go down, go write down what works for me. Give me 20 minutes, I'll get right back to you. 20 minutes later, this is kind of the structure that I came up with. And so what I calculated was if he could hold $240,000 as a second note or a seller financing note, and I'd still get the $900,000 from the bank. Right, so the bank was still going to kick in 75%, which was $900,000 of the 1.2. The seller was going to put in $240,000, not put in, but just basically he's not going to. When you seller finance, he's not going to take it out. So what that means is we're going to give him basically he has a package of which we're going to buy this property. We're going to buy this property for $1.2 million. He has the package purchase price of $1.2 million. He's not going to get all $1.2 today. He's going to get the $900,000 from the bank. Now, the seller only had like $300,000, $200,000 of debt on the property. So he was able to turn around, pay off his debt with what the bank paid him, and he still had $600,000, $500,000, $700,000 left after that, right? Now, the remaining $240,000 he kept in the deal as seller financing, meaning he was not going to get this today. He was going to get the $240,000 paid out at a 3.5% interest rate over the next 3 years, and then at the end of 3 years, obviously, just making the minimum payments on this, we're not going to have the whole thing paid off. But with whatever was paid off, we were going to refinance the property and pay him off in a balloon payment after 3 years. Now, when I set this up, what I recommend to people usually is give yourself as long of a runway as possible. Did I think it was possible that we could buy this deal and probably have him paid off in 6 months? Yeah. But you know what? When I give myself that short of a runway, there's a lot less margin for error, and I didn't feel comfortable doing that. This deal, I felt comfortable at 3 years. There's a lot of times that I'm not comfortable doing it less than 5 years, 7 years. So again, the more time that you have with the seller financing note or any note in general, the more margin for error you have. Time is always something that you want on your side. If you have time, you will never, ever, ever lose in real estate as long as you have enough time. We were going to put in $60,000. So the $60,000 of our own equity that we were going to put in sure beats coming up with $300,000 of our own money, and sure beat coming up with $1.2 million of our own money. So we put in $60,000, the investors did. The seller held $240,000. The bank gave us $900,000. I hope those numbers add up, and they do. They add up to $1.2 million. Again, this is a real life scenario. So what we did next was, hey, I'm also pretty creative when it comes up to this piece right here. Because again, the equity can be treated just like working with a seller. The equity can be, it's going back to how we divvy up, how we divvy up the proceeds or the benefits of what you're going to get for trading equity, right? It's also blank slate. You get to put the terms on it. What I did was basically, I kept 72%, even though I put in zero for $0. I kept 72% of this whole deal. I owned 72% of it. I put in $0 of the $60,000. We gave up 15% equity for this $60,000. So one investor came in. I said, hey, Mrs. Investor, we need $60,000 that we're raising here. We're going to give you 15% of the entire deal. And this person knew they were putting up all the equity, by the way. You're going to get 15% of the entire deal, plus you're going to get a 6% preferred return on your money, pref, which means annually she was going to get a 6% of the $60,000. 60,000 times 0.06 was $3,600 a year, which is $300 a month. So the perk for this person putting $60,000 in is this person out there was running a successful business. That's where all the time was spent. Did not understand the real estate game, but knew that she wanted money working for her. So she put the $60,000 in. She got 15% equity of the entire storage unit deal. Plus on top of that, for being the only person that put money in, she got a 6% preferred return on her money, which is another $3,600 a year. I put in zero. I had 72%. 13% went to a manager and my buddy because he was going to manage the deal. He found the deal, so we got him a 13% equity stake. So I came up with this number, and I came up with this number. That's 28%. What does that leave left, right? 100% of the equity minus 13% minus 15% leaves me with 72% equity. That's how I figured out how much equity I was going to get for putting the whole deal together, I signed on the docs as far as guaranteeing the debt and all that stuff. What we did now, right? Going to the operation of the deal, because I want you to see how the whole cash flow works, and I want you to see kind of the difference in what might be difference in interest rate, which I'll talk about in a second, which is kind of Chris's direct question if I'm understanding it correctly. I'm also going to show how you can multiply and just really the velocity of your capital can really multiply in these seller financing deals, but then also getting creative with how you're raising your equity and how you put together the capital stack, right? When I say capital stack, what I mean is to get to the $1.2 million purchase price, what does the capital stack look like to get there? Meaning how much debt, right? Well, we got $900,000 from the bank. That's one piece of the capital stack, making up the 1.2. The $240,000 from the seller financing, that's another part of the capital stack. And the third part of the capital stack was the $60,000 of investor equity that we put in. This is the capital stack that gets us to the total purchase price of $1.2 million. So going back to the actual property, right? So we have revenue. All properties have revenue. It is a business. All businesses have revenue. And again, this can be used for businesses that you're looking to buy. This can be used for real estate that you're looking to buy. Net operating income, the debt payments, which is principal and interest, how much you pay. This is the cash flow. Okay, and then down here we have the cash on cash percentage return. So what that is that's an annual percentage on the equity that you got in the deal. So if I go to the revenue is a constant. The revenue is not going to change based on if we're doing all cash, traditional financing, or seller financing. So the revenue is the revenue is the revenue. The revenue is $171,000, whether we do all cash, traditional, or seller financing. So it's $171,000 all the way across the board, either way, no matter how we do it. The NOI is $120,000, so that means there's $51,000 of expenses. So revenue minus your operating expenses. Operating expenses do not include the debt payments. It only includes the utilities, the insurance, the snow removal, the lawn care, repairs and maintenance, the payroll for an on-site manager, the admin expenses to run the management software, the real estate taxes, those are operating expenses. So in this scenario, it was $171,000 of revenue, no matter what debt type we had. The NOI, so the expenses were $51,000, which I don't have on here. The NOI is $120,000, right? Net operating income is $120,000. Now the debt's different. The debt's different based on terms, based on seller financing, based on an interest rate, based on amortization, based on the loan, on if the loan is interest only or not, based on if there's insurance on the mortgage that you got to pay. So the debt, in an all cash scenario, on a $1.2 million purchase, you're putting in your own equity or investor's equity of $1.2 million. That means you have zero debt. If you have zero debt and the net operating income is $120,000, your cash flow is $120,000, When you take $120,000 and you divide that by $1.2 million, it gives you your cash on cash return, which is 10% in a scenario where you're paying all cash and you're putting $1.2 million down. If I put $1.2 million down, I trade it to get the annual cash flow of $120,000. That $120,000, it would take me 10 years basically to get my initial investment back. It's a 10% cash on cash return. I got a cash outlay of 1.2, and every single year annually, it's bringing me back $120,000. Does that make sense, Danny?
Yes.
Traditional, now if we go the traditional route, right? The traditional route, if you jump right to the cash on cash return, annualized cash on cash return is 23%. It's 13%, it's more than double the return of the cash on cash. Why? Is because now this is levered. You're using leverage. Leverage is debt, right? This is why I'm always going to want debt in my properties. Number one is because I want to be able to use leverage, which increase my cash on cash returns, but also the interest that I pay is a tax write-off. If I have zero debt, I don't pay any interest, so my cash on cash return is lower, but also I have less write-offs. I need, as these properties get rocking and rolling, you need as much as you can have from a write-off. You might as well use other people's money or the bank's money to get the write-off and to leverage your returns. It does not mean that we're going to be leveraged 100% or 85%. It might be 50%. It might be 65% loan to value. It doesn't mean we need to over-lever, but we should always have some leverage. In a traditional scenario, if the purchase price is $1.2 million, the bank is going to give me $900,000. I'm going to have to put in $300,000. That means the $300,000 that I'm putting in is my own equity, plus the bank's $900,000 equals the $1.2 million purchase price. Here is the capital stack. Here's the purchase price. We're still at $171,000 of revenue, $120,000 of net operating income. Principal and interest on this is about $50,000 ballpark. So it's the interest rate's 4% plus the principal, ballpark $50,000 out. So now I've got $120,000 of NOI to cover the $50,000 of debt payments. That will give me $70,000 of free cash flow remaining. And when I do $70,000 divided by 300, right? Because I'm trading $300,000 for control of the property, and in exchange for control of the property, in exchange for $300,000, I'm going to get the control of the property, and I'm also going to get $70,000 of free cash flow a year. That free cash flow is 23%, is a 23% annualized cash on cash return. The actual cash flow that I'm getting is less because I have to pay the debt. So over here, I'm actually getting more cash flow, but I have to trade $1.2 million that I had in savings or from other investments or whatever to get the $120,000. Again, going to 10%. Over here, I get less cash flow in dollars, but I have a higher return because I'm having to trade less. I'm trading $300,000 today to get the $70,000, which is a 23% annualized return. Let's say that the bank loaned at 4%. Going back to Chris Wormley's question, he asked, his direct question had something to do with what's the difference in the interest rate that you pay, and I don't know if he said it incorrectly or if that's actually what he meant, or he meant something a little bit different. If you did mean something a little bit different, Chris, that's why I'm going into a lot of depth here on seller financing. The actual interest rate that you pay a seller, it just depends on the market. If I'm going back to this deal, right, I had the bank give us a 4% interest rate. That's what they offered. I gave the seller an option of seller financing at a 3.5% interest rate. Sometimes the seller is going to want a higher rate than what the bank's giving you. Sometimes they're willing to go with less. In this scenario, he's willing to go with less because, remember, nobody else could get to the $1.2 million total compensation package that I could get to. So I said, Mr. Seller, I'm $400,000 above the last person that came across your table. And so for an exchange for that, you're going to do the seller financing at $240,000, and the interest rate's not going to be 5.5%. It's not going to be 6%. It's actually going to be less than the bank note. It's going to be 3.5%. He said, okay, because he wanted, this was what was important to him. Now, if the interest rate was important to him, what I would have done is I would have adjusted my price, but he can't have both, right? In a negotiation, you got to be able to move. Each party has to be able to move and meet somewhere in the middle. Now, sometimes the middle is still more favorable and closer to the seller. Sometimes it's more favorable and closer to the buyer. If you talk to either one of them at the end of the deal, they'll always say they got the shorter stick. That's just how it goes. So in this scenario, we still have the $171,000 of revenue that the property generates. We still have the $120,000 of net operating income. Now the bank is still going to get its $50,000. The bank over here, $900,000 traditional financing at 4%. The bank over here, seller financing, the bank still took on a $900,000 portion at 4%. So we're still paying the bank $50,000. But now on top of that, we have the seller piece And again, this is not interest only, this is, amortizing. But we're going to pay the seller $10K. So that's part of that is interest, part of that is principal. $120,000 minus the $60,000 total debt gives us $60,000. So again, of free cash flow. $60,000 of free cash flow. So it's $10,000 less than this scenario. It's $120,000 in this scenario. But we only needed to raise $60,000 to get the $60,000 of free cash flow, which is a 100% annualized return. If you remember me talking about how the equity broke out, I owned 72%. It was 72% owner, a 15% owner, and a 13% owner. So what happened next with that 60,000 times 0.72, I got to keep 43,000 of that. Our investor who put in the 60,000, she made 9,000 plus the 3,600 for a total of about 12,600. The 13% equity owner for no money in got 7,800 plus also got paid, management fee and all that stuff. A manager, made other compensation on top of that. But that's how this 60,000 was split up. So you look at my actual now this is just the cash on cash return of the equity, right? So this is at the deal level. But again, outside of that, you can be creative with how you structure the equity stack. So this, my 43,000 was an infinite return. I traded my mental capacity, my creativity, my signature on the loan docs, my ability to get a deal done, my courage. That's what I traded. I didn't trade. I still traded something. I traded effort. I traded headache. I traded the negotiation skill, the negotiation power. I traded the education that I got the previous 6-7 years. And I got an infinite return because I made $43,000 that year on that deal. Let's go look at this 15%. The 15%, what that person traded to get the 15% plus the 6% preferred return. That investor traded $60,000. That's what she was willing to exchange. She exchanged the $60,000. She got 15% equity, which was paid her $9,000 in year one, plus the $3,600. So she made $12,600. What's that return on her money? Let's see. On her money, $12,600 divided by 60,000, that's still 21%. She made a 21% annualized return on her money. So do you see why she would do this? When I first tell people about this deal, people are like, man, you ripped the person off. I'm like, trust me, did not rip the person off. I think almost any investor out there would gladly take 21% annually on their money. Not to mention what I'm going to show in a second, this huge windfall that we had. This 13% owner, my buddy, infinite return on the $7,800, right? He didn't trade. He traded, he brought the deal to me. The investor happened to be his grandma. He managed the deal more than I did. So when it came to chasing money, giving late notices, filling units, I probably did like 20% of that. He probably did about 80% of that. So he got that equity portion, and then plus he also was compensated for his efforts in the day-to-day managing it, which was an infinite return. What happened with this, right? Remember how I said your terms can be creative. You can say whatever you want to, have in the deal and negotiate in whatever piece you want. Part of this negotiation piece and why we were able to actually perform on some of this stuff, and actually we performed better than this because we actually increased this revenue to about $195,000 year one. So all these numbers were low. The reason we were able to do that is because remember how I said it was about 75% occupied? When I went to the seller and I said, hey, you're going to hold a mortgage and I'm going to get you the 1.2, but also as a part of the deal, I get to start marketing this property right now so that we can fill it up. And he said, sure. And the reason he said sure was because I said, you don't have to pay me anything. I will market it. We will market it. We will show the units. We will sign leases on the units. You don't have to pay us anything to do that. We only benefit if this deal closes, because now it's going to be more full for us once we close, like day one right away. And I said, if the deal does not close for whatever reason, you still do not have to pay us anything. Even if we fill it up to 95% occupied, you just get to keep it, and we'll just walk away. And so, who wouldn't say yes to that? So he let us do that. By the time we closed, we were 95% occupied, something like that. And so what happened was, we built a lot of this. 8 months later. It was not worth 1.2. It was worth about $1.8 million after we did that. And so now you look at the debt that we had on the property. Get my calculator out quick. You look at the debt we had on the property. I take the 1.8 minus the 900,000 minus 240,000. That means there was 660,000 of value here at that moment in time. And remember, I got to keep 72%. So on top of making 43,000 for putting the deal together, I now had an asset on my balance sheet 660,000, because that's the net, times 0.72 of 470,000 for zero. I traded, again, I didn't trade any money. I traded my mental capacity and all that stuff like I talked about before for the 43,000 plus the 475,000 on my personal balance sheet as an asset that paid me every single month. Because this was now worth 1.8, we actually ended up finding another storage unit facility that was for sale. Once we closed on that, it doubled our size. What we did was that seller was not, in that new deal, was not looking to do seller financing. We tried. Wasn't looking to do it. We were able to refinance this whole thing. We got this seller, he was gone. We refinanced this. We pulled the equity out to put it into the new deal. We kind of did the same thing as far as value add, right? There was vacancy, the rents were under market, so we cranked it. After 30 months from day one here, we had turned this $60,000 because 30 months later we sold the whole package to a buyer for about, I don't know, I think we sold, it was about 3.6 million bucks that we sold it to a 1031 buyer. We turned the 60,000 into over 1 million in the 30 months. 60,000 turned into $1 million of this includes the annual distributions, and this includes the sales proceeds. So again, when you look at 72% and how this broke out, 720K came to me for, again, putting the deal together, signing on the loan docs, right? For our investor, she got 15, so she had 150,000. Plus, she had 30 months of the $300 payments for preferred return, so she had 30 months times the 300, which is another 9,000. So she made 159K off the deal, which 30 months prior, she had the 60,000. Turned into 159. My buddy, 13%, 0.13, I don't need the calculator to do that, walked with 130,000. Here's the crazy thing about this. When we sold this deal, we did a 1031. So this entire $720,000 I put into 96 East, a 96 unit. That 96 unit we bought for like $40,000 a door. It's probably worth $70,000 a door now. So I took the 720. By the way, these guys all rolled it forward as well. So this million at the time, because this has increased. So the 1 million, right, that we put in here in May 2019 is now, we still have the property. We still own this. It's cash flowing. Every single month it's cash flowing money out. But it's the value of the 1 million that's sitting in there, it's probably increased 75%. So the 1 million is now worth 1.75 million. If I've got 72% of that, the 1.75 million, 72% owner, the 15% owner, 13% owner, 175 million times 0.72, 1.26 million, 262,227,000 is what the value is. So you got to remember, these are investments or capital at work, because every single month it's paying out right now ballpark on the 1.75 total. It's paying about $175,000 annually in cash flow, which if you divide it by 12, it's paying us $14,000 a month collectively, the three of us, just from one flow, right? Now this, and all of this, and all of this, and the 1031, and all of this, I feel like John Madden up here, is all from the $60,000 that we started there with seller financing. And the reason that I'm sharing this with you is because the last 5-6 years, there's been so much demand out there, people have not even had to look at using seller financing from a selling standpoint. And over the next 4 to 12 months, 4 to 18 months, there's going to be seller financing opportunities for businesses that are doing $500,000 to $15 million a year revenue. There's going to be seller financing opportunities. For real estate deals, there's going to be seller financing opportunities. Are there going to be as many as there was in 2008, 2009, 2010, 11, 12, 13, 14, 15? I don't know. Probably not. Maybe. This is how you can structure deals with sellers, but I also talked a lot about the whole equity stack as well and how you can be creative using your knowledge, using your courage to put yourself in a position where you've got zero money. I traded zero. I traded zero money for this, plus 72% of that, plus, so it's almost $100,000 a year. I traded zero for it, $0. But it was the education, it was the know-how to do the deal, right? And so I'm always talking about, if you want to do this thing, you got to learn. Why do you got to learn? Because that's you learning and you putting money into yourself to know how to do things obviously pays dividends. If I didn't know, if I didn't teach myself, if I didn't put money and resources into myself to have this knowledge, I would have never been able to get someone to put $60,000 in, for me to put $0 in and still own 72% of it, and to make some big wins happen for a lot of people. This is just one deal that is paid off from me learning, right? So you got to find a way to learn. You got to find a way to make some money so you can accelerate this, right? Because now I get to the point where I'm getting equity essentially for free and for putting deals together, but I'm also putting in $200,000, $300,000, $600,000 into each deal that we're doing because I found a way to make money, right? I learned, I found a way to make money, I stash the money, I then invest the money, and then I just keep repeating. And you do this 5 times, 8 times, 10 times, 12 times. We've got 11 deals that have gone full cycle. We've got like 28 properties still. We've got 1,800 units. This is like a snowball. You do this over and over again, and now you don't got to worry about your house, your personal expenses are going to be paid for by cash flow. This is why I'm talking about cash flow being so powerful. I don't have to show up every single day. Like when I die, this money that I did from this money is still going to be paying, like generations from now, it's still going to be paying somebody. Whether it's a charity, whether it's my daughter, my granddaughter, my grandson, going to be paying somebody. Go find a way to learn, invest in yourself, and then have the courage to go do some deals.